Hey everyone, Eric here. In this video, I'm going to teach you about seed funding for startups and the most important metrics you need to present to investors when raising money. By the end of this lesson, you'll know exactly what information you'll need to have ready before you start fundraising. Okay, let's get started. So in today's lesson, we are going to be talking about market sizing, traction, business model, so that's how you make money in your forecasts, and valuation. So how would you want to present this data to investors in a slide deck or just passing them the information directly? What we're not going to cover is the story, problem, solution, market dynamics, and team, because that's obviously unique to every business. But these specific metrics are similar in every business, and there's a few common approaches on how to calculate these. And so that's what we're going to walk through today. So first, let's talk about market size. Okay, so for market size, generally what people refer to is something you'll hear called the TAM, the TAM, and that's the total addressable market. How big is the TAM? So you want to make sure that your TAM is big, in the billions, at least 1 billion. You want to be able to hit 1 billion in revenue. So if your TAM was 1 billion, you want to be able to monopolize that entire market. Or if your TAM is much bigger than that, you want to be able to take some kind of market share. And so when you're calculating TAM, a lot of startups say, well, what is our TAM? How do we calculate that? There's really two different ways to think about TAM. You can either use a top-down TAM or a bottoms-up TAM, or sometimes you need to blend the two of them. So I'm going to talk about businesses in each of these situations right now. So top-down TAM is when you are trying to take market share from an already existing market with a better product, service, etc. So, if you're in a certain market, you could say the TAM is projected to reach 6.1 billion by the end of 2022, growing at 12% CAGR, that's compound annual growth rate. That means it's, growth per year through 2030 and source. So let's say you're in some industry, if there was some existing industry but very bad solutions in the industry, you would know how much is being spent on their services, and you said we're going to build a much better service and we're going to take market share, and this is the size of the market. Okay, so that's a simple top-down TAM. The next one is the bottoms-up TAM. So a lot of times you're building something and there isn't really a TAM, or there's not a very big TAM, but you think your product would be adopted by many people. So you use a bottoms-up TAM when you're creating something entirely new. So no one predicted, for example, that PCs or mobile phones would be adopted by 100% of the population. When these first came out, they weren't very user-friendly. And so the believers in these technologies said, people will not be able to live without a mobile phone. And at the time, that seemed outrageous. But today, they're right, or people will not be able to live without a computer. So in the bottoms-up TAM calculation, you need to make a statement about the future. So people won't be able to live without mobile phones, or X group of people won't be able to live without this. My product costs X per year to use or buy, and so it's this many people times my product in the market is X. And so in those situations, you need to kind of walk through it based on those sets of assumptions, and that's totally fine. And then the third way is when there is an existing TAM, but you think that your product will grow the TAM and the market will be much bigger because much people will effectively enter this market because your product is so much more valuable than whatever the current solution is. So there are some very obvious examples of this. Uber is a big one. So there was the taxi market had a certain size, but when Uber and rideshare came into the market itself grew much, much faster because the product was so much better than a taxi. And so now everyone's doing rideshares, and a lot of the people who are now doing Uber and rideshare, et cetera, weren't taking taxis before. So the TAM itself grew massively because the technology was so much better than the previous technology. Another one's iPhones. The mobile phones that existed before the iPhone came out were a tiny fraction of the price of an iPhone. And so the market had, some kind of a TAM. And when the iPhone came out, they found out that people were willing to pay 2, 3, 4, 5 times more for a phone because the phone was so much better and was so much more valuable. And so the iPhone grew the TAM of mobile phones massively because people were willing to pay more money for this product. So these are the three ways you can talk about this. And this is the kind of chart that you'd want to include in a slide deck. And I made up some data down below, and it's just kind of year revenue, XYZ industry global revenue. So that's how you think about market sizing in a slide deck. Okay, now we are going to talk about traction. But before we move forward, if you're an early stage startup, I need to tell you about Notion, which is my favorite collaboration tool, the favorite tool of some of the most successful startups I've worked with, and also the sponsor of today's video. Notion is awesome. I use it to keep track of the status of everything I'm working on, which you can see right here on this dashboard. It allows me to have one centralized place to store everything in a linked and searchable way, communicate with team members, and keep all of the projects moving forward. Okay, I use Notion for a lot of things, but let me just show you one thing that I use it for. So it's keeping track of tasks. So if I want to add a task, I would say follow up with Notion. And when I open up this task, you'll see that it turns into a doc. So I can put the notes in here, the to-dos. Let's say I'd had a meeting with Notion, and in my meeting notes, I have a document with the Notion meeting notes, and I have the whole document. And here, what I can basically just do is link that document into the task very easily, @ Notion meeting notes, link it straight in. I can put a reminder, remind me, I could say tomorrow, or I could choose the 29th. I can also tag a team member. Did you speak with Sarah? So there's so many different ways that you can keep track of what you're working on. And then I just assign different statuses. I can say to do, I can assign, different team members. I can give it a date. Let's say it's the 29th. I give it a status and I say Notion. If I didn't have Notion, all you do is just type in Notion and it just adds it straight to the drop-down list. And the cool thing is, of course, you can see the statuses, but it also calendarizes the due dates. So I chose the 29th, and here you can see follow up with Notion. Before using Notion, we used a combination of Google Docs, calendar reminders, email, text. We lost track of a lot of pieces. So transitioning to start using Notion only took me a few hours. It's really an all-in-one tool. I use it for my personal life as well as my work life. So check out Notion. You're going to love using it. Use my link in the description below to get started completely for free today with a personal plan. Plus, if you identify as a startup, you can apply for $1,000 off your team's Notion plan. Okay, back to the video. So now that we've talked about TAM, now we need to talk about what are the metrics that can back up your traction. So if you say we've got a great business, investors are going to say prove it, and they're going to ask, is there growth? Do people want to buy this product? And is there product market fit? Meaning, when people buy it, do they continuously use it? So is there customer retention? So growth and customer retention are the ways that you tell this story. So we're going to talk about growth. Then we're going to move to retention for user-based businesses, subscription, and other types of businesses like e-commerce, marketplaces, and businesses with revenue. So let's talk about growth. So first things first, your growth metric should be measured by the number one thing your business is trying to achieve. So that's usually users, revenue, or bookings. Could be something else, but probably not. So you can't use a strange or kind of not believable metric. It has to be the core thing that demonstrates that you are achieving success. And so in terms of growth rates, at the very early stage, so a lot of these businesses and accelerators are targeting 10% week over week growth rates. Those are considered extremely high. 10%, why would 10% be considered extremely high? Well, here, if we say 10%, if you compound 10% for 52 weeks, which is 1 year, you actually grow 14,000%. So, if our revenue was $100 on week 1, then by the end of the year, if we could just grow it at 10% every week, it would be, well, I can tell you, it would be $14,000, but it would be $14,000 per week by the end of the year. So 10% growth isn't realistic for a very long period of time, but if you just launched your product, say, and you've had it in the market for a couple weeks or maybe even a couple months, sure, week over week growth rates are good things to put on a deck to show, hey, look, this is our growth so far, a slide that shows that. And so this is the type of slide that you'd have on like a fundraising deck if you just launched, okay, weekly growth. On the primary vertical axis, you have revenue. And so the bars that show the revenue kind of going up, that's just this information here. And then you could have another line which shows percent revenue growth per week. This is bouncing around a little bit. One way to create sort of a growth trend line is something called compound weekly growth rate, or you can do compound monthly growth rate or compound annual growth rate. And this just takes basically the end week 7 revenue and the week 1 revenue, and it figures out if this revenue started at 563 and compounded the same amount every week, how fast would it need to compound to get to 1102? So it gives you like an average, kind of an IRR. And so the formula is just final week divided by the first week, raised to the power of 1 divided by the number of weeks. So that's 6 weeks, 1, 2, 3, 4, 5, 6, minus 1. And it says, okay, the revenue is compounding roughly 12% a week. So it's just because this line's a little bit squiggly and it's sort of hard visually to understand roughly how fast are we growing. And this is a great metric to use on a monthly basis too for businesses that have seasonality or their revenues like grows 50% in 1 month and then flat the next month, to use sort of a compound growth rate over a long period of time. So if you're past the sort of super early launch phase, 25% monthly growth rates are considered very, very high. And so that's another sort of benchmark to think about. Now let's talk about retention. So first, let's talk about user-based businesses. So these are businesses where the goal is to get users to sign up and use it. So social networks and any user-based business. So you have the DAU-MAU ratio, and then you have power user curves. So daily active users is what we call DAU, and monthly active users is what we call MAU. And so you're basically saying there's 136 people that use our product every single day, but on a monthly basis, 912 people use it. So that means that effectively, there's 776 people that don't use it every day. And so you basically say, what's the DAU-MAU ratio? You say 15% of our users are using the product every single day. Okay, so that tells you that you do have a cohort of users who are liking the product and they're using it a lot. It doesn't give you that much precision in understanding your power users. And so in this case, we're always trying to figure out how many power users do you have. And why are power users important? Well, the people who use the product every day are going to drive all the monetization, whether that's ad impressions, whether that's signing up to pay for the product, etc. It's going to be the people that use the product every day, not the people that log in 3 times a month. And so you're trying to figure out how many power users do you have to figure out if you have a business. And so to really understand power users, the DAU-MAU ratio, it's good, calculate it, but it falls a little short in telling you the story. So here's where you want to see something called power user curves, which are called sometimes smile curves. So here's a power user curve. So the underlying data looks like this. You basically say, okay, I have this 1 week of data. 40% of my users use my product 1 day in the week. 18% use 2 days per week, 9% use 3, et cetera, 6% use 6 days per week, and 14% use 7 days per week. And you create this bar chart. And effectively, what you want to see is a smile. If you see it trailing to 0 and that the people that use it every day are 0%, well, that means you don't really have any power users. But if 14% of your users are logging in every day, this smile means that you do have a chunk of your users that are basically loving it, loving the product. They're finding it really valuable, really fun, whatever it is. And so the power user curve gives you a much better sense of sort of what is the distribution of usage than just this one number. And if you want to get even more exact, this would be June 23rd weekly active users. What does the usage look like? You can also look at it on a monthly basis, exact same data. You just say 19% of people used it once per month, 1% used it 17 days per month, 7% of people used it 31 days per month, etc. And if your curve is not smiling, you shouldn't be smiling either, because that means that you don't really have any power users. And so you want to call this is also called the smile curve because you want the curve to be smiling. Okay, so next let's move to churn and retention cohorts. So this covers the business models that effectively have revenue. So in any business model this works for. So again, we're going to talk about kind of a crude metric and then a more sophisticated metric similar to the Dow Mao and the power user curve. So churn is a pretty crude metric, but it tells you something informational about specifically SaaS businesses. Businesses where the customers have signed up to pay every single month. In order to stop paying, they need to specifically cancel. So churn is the cancellation rate per month or per period of time that they've signed up for. That could also be per year. So in this case, what we would say is you have new customer signups, churned, which are cancellations, and then total recurring. So you'd say 7 people signed up, 1 churned, let's say from a prior month, and you have 6 recurring subscription customers. Then 14 people signed up that are new, 0 churned, and so total you have the prior month total recurring customers plus your new 14 customers. And then in month 3, you have 20 recurring, you add 21 new, and then 3 churn. And you have 38 total recurring at the end of the month. So what percentage of your customers canceled? Well, it's 15% of the prior month's recurring customers, because the customers that sign up in this month, the 21 customers, they aren't the customers that are churning. They just signed up. So the denominator of the churn is really the prior month total. So in this month, you'd say, okay, 2 out of the prior month's 38 customers churned, and now our total recurring 72. In this, you'd say, okay, 6 of the 72 churned. That's 8%. And so you see your churn rate is kind of bouncing around, but overall, your churn rate is 8%. So you can say, in any given month, roughly 8% of our customers churn. And so that tells you, there's some benchmarks around churn. Sort of more than 10% isn't great for a B2C company. Okay, so now let's talk about cohorts. And cohorts are the better metric to think about any revenue-based business, including SaaS, because they don't just look at sort of cancellations, which we would call revenue contraction. They also look at increased purchasing for SaaS businesses, which is revenue expansion. And then for all other types of businesses, it shows you a really clean view of how customers buy over time. And so this is the best to really use for any non-user-based business. So how does a customer cohort work? So what it shows is groups of customers based on the initial purchase month. So this group of customers bought for the first time in January 2022. And what this cohort is showing revenue per customer over their lifetime. So we're saying that a certain group of customers bought for the first time in June 2022, and they spent on average $102 of revenue per customer. By month 2, they spent some more. Maybe some of them disappeared. Maybe some of them spent twice, 3 times as much, but on average, they spent now $189. That's their cumulative lifetime revenue. By month 3, 212, and all the way to 309. And it could be that by this time, it's a smaller group of the original customers, but on average, it's 309. You divide the total revenue by the initial purchase group, and that number in the denominator doesn't change. So we're saying that on average, each customer by month 6, we expect to spend about $309, even though in the first month they buy with us, they only spend $102. So the same with the July cohort. So what's month 2 of the July cohort? This is July. They spend $120.21. What is month 2? Well, July, August. So this is in August. So August is actually here. This is the first month of the August cohort, second month the July cohort, third month the June cohort. So September is diagonally. And so this is a way to look at how do customers continuously spend over time. Doesn't matter if it's SaaS. The churn rate doesn't really matter. It shows you how much do people actually spend, and it strips out a lot of the noise. So why does this matter? Well, first off, these are great tables for building forecasts off of, and it can help you anticipate your customer retention. So you could say, okay, well, what do we expect, in this would be the December. Well, you can actually look at, okay, how is this number increasing? Maybe we expect this to get to 245, this, and you can actually forecast very accurately your customer retention using these tables. I do that in a lot of the models. I do it in my marketplace financial model. You can go check that out on my YouTube as well. And so we're saying that in month 6, we expect a customer to spend $309 cumulatively. What if our gross profit margin is 71%? That means that our cumulative lifetime gross profit at month 6, which is actually our customer lifetime value, we expect to be about $219. That's what we'll make in gross profit off them. Well, why does that matter? Because if we expect to make $219 of profit off a customer, well, we know how much we can spend in marketing to acquire that customer. So we can spend no more than $219. But let's say our CAC, which is our average marketing spend to get a new customer, is $115. Well, if in month one you said, well, they only made we only made $101 of revenue off them in their first month, we can't spend $115 in marketing to acquire that customer. But if you could see that by month 6, they were spending $309 and $219 of that is profit, well, then you can easily spend $115 in marketing to acquire them because you're still going to make $100 of profit after recovering your CAC. And so that's the power of cohorts. They tell you a lot about your payback cycles and your marketing costs. So the next thing that we would want to cover when fundraising is the business model. Okay, what's your business model? They would say, how do you make money? How much have you made? And how much do you hope to make? I see a lot of decks that, when you look at the slides about the business model, you just scratch your head at the end. You're like, I still don't get it. That's not what you want to happen. You want it to be very clear. Here's how much money we make on a customer, and that's called your unit economics. How much have you made? So you want to be able to show your traction in a very simple chart. I'm going to show you some examples. How much do you plan to make? Here's a projection about the future. So it's really 3 different things. So how do you make money? Unit economics. So your unit economics are the financial breakdown of your relationship with one customer. This makes it very clear to an investor how you make money. So we're saying in this case, we're a B2C SaaS business. So that generally means that people can cancel every month, but sometimes it's on an annual basis as well. But we're saying this is a monthly cancellation business. So we're saying the price is $17 a month. So in the first month of our relationship with them, we make $17. There's no churn because it's just 1 month. They make 1 order. The gross profit is 71%. So in profit, we make $12. They spend $17. We spend basically $5 to run the product and $12 in profit. Okay, great. So that's how we make money. The lifetime should also be included in how do you make money. So the lifetime is, okay, if we include our churn rate because we're a subscription business, you could also get this 12.5 by looking at the cohorts. You could say, okay, what's our lifetime revenue? If we extended all the cohorts, okay, by month 12 or by month 20, what's our average revenue per customer? That's a more accurate way to get it. But let's say we just had churn rate. We would basically say, okay, 1 divided by the churn rate is 12.5. That's a mathematical shortcut to know that if 12% of our customers are churning, the average customer has a 12.5 month lifetime. If you have an 8% churn rate per month. So 12.5. And so if we do the math, $17 times 12.5 months, $212 at a 71% gross profit margin, we make $151 per customer over 12 months. And our CAC is $39. We know that because we're acquiring customers on average is costing us $39 in marketing to get a new customer. So our LTV to CAC ratio is 3.87. If you had this on a slide, an investor would be very happy, and it would show that you really understand your metrics. So this is called unit economics. How do you make money? There it is. That's how we make it. If you had a different business model, let's say a freemium app, so you're acquiring customers, some percent of them get upsold into your product, et cetera, et cetera. So we can just walk through that on a very simple slide. So month 1, your product costs $109 per year. Your gross profit margin is 81%. You make $88. Okay, but what's your customer acquisition cost? Because most of your customers are using the product for free. How much does it cost in overall marketing to get a paid customer? So we know that this product is actually an annual subscription, and after 1 year, 30% of people cancel. So our churn rate is 30% per year. 1 divided by 30% is 3.3 years. Our lifetime revenue is $363 on average. Lifetime gross profit is $294, and so that's your customer lifetime value. Your total gross profit earned over your lifetime relationship with one customer. Okay, so now the question is, how much did we spend on marketing to make that $294? So we're saying that we spent $4,000 on marketing to get 1,000 users. So our CAC per free user is $3.99. Let's say 5% of our free users convert to paid. So 50 of the 1,000 convert to paid. So 50 divided by the marketing is an average CAC of $80. Customer acquisition costs $80. So again, we spent $80 to acquire a user, and then we expect to make $294 on our lifetime relationship with that customer in terms of gross profit. So our LTV to CAC ratio is 3.69. That is how we make money. So this is a great way to explain that in your seed fundraise. Now, how much money have you made? So in this case, you just want to show a really simple traction slide with whatever data that you have. So you'd want to show something like, oh, here's over the last couple months, here's our revenue. If you had a first couple years, you could show, here's the first couple years. In this case, I just said, here's year one, H1, so that's the first half. Year one, H2, you could show this quarterly. I said, here's how many free users we had. Here's how many paid users we had. So we're assuming this kind of like some kind of app that's a sort of freemium. So we had a certain amount of paid users, certain amount of revenue, certain amount of net income. And so here I said, here's our revenue in the first half. Here's our effectively burn. Here's our revenue. Here's our burn. And it's going up. And this is our paid users going up. And so you just want to show that you're making money. You know how much money you're burning. You could also include in this chart maybe like your average revenue per user going up over time as you monetize users more effectively. $7 is not very much in terms of average revenue per user. I think like Facebook and Twitter is north of 100. Obviously, they're monetizing users very well, but just as a reference point. So you could use that as an argument that you can monetize your business much more. Next, how much money do you plan to make? So you'll see a lot of businesses just have a kind of a projection slide that shows, if everything goes right, here is what we expect our business to look like over the next 5 years. Generally, it'll show, the revenue scaling up. You'd want some kind of a model behind this that you can, you have under assumptions that underwrite these numbers, but, you'd effectively show an extension of your traction with your projections. And some people also actually just include it all in one chart. And so they would say like, actuals, year one, year two, and the rest would say like projections. So that's what I did on this chart. I said year one, year two, these are actuals here, and here's the projections. And so you can show it all in one chart for how much money do you plan to make. Okay, valuation. What valuation should you raise at? How much should you target in terms of your raise? And then what kind of dilution should you expect? This is going to be a shorter section. I'm just going to chat through how to think about this, what to expect. So valuations are extremely market driven. So in the best case scenario, you have an investor who can set the cap. And so they'll set the valuation cap and they'll say, okay, I'll invest it at 8 million valuation. And then everyone who comes in behind them, they would generally be the lead investor. Everyone who comes in behind them is just going to invest at the same price. If no one investor will set the cap and kind of lead the round, you can set it based on competitors. And so, do your best to set it. And, if it's not a competitive valuation, then investors won't invest. And so these are very, very much market-driven numbers. A big consideration for your valuation is you need to think about how much do you need to raise. So ideally 12 to 24 months. Right now we're going into a really rough time for fundraising. And so you want to target the longest period of time just in case you can't raise money for a while because consumer demand might be lower and then investor demand might be lower. So you might say 24 months. And so you would, if you wanted to raise, say, $1 million and you don't want too much dilution, you can kind of back into, okay, if I don't want to sell more than 20% of my company, or an investor maybe says, I want to own 20% of your company, you say, I want to raise $1 million, then you back into the 5 million valuation. So very market driven. Try to raise enough money to hit profitability or make it 24 months. And then dilution, what percentage of your company do you lose? Seed rounds usually require sort of like 10 to 25% dilution, sort of depends, but that's a range you should expect. And so the way that dilution is actually calculated is kind of works like this. So you'd have founders, and they would have, like let's say 100 shares each, the founding team. And your seed round, you might issue an additional 15 shares. So then your total shares would actually be 115. And so your founders would get diluted effectively 13%, because they, of the 115 shares, they effectively own 13% less of the company now. And in their Series A, let's say we issued another 21 shares, and now the total is 136 shares. That's another 15% dilution. So the founders, between the founding of the company and the Series A, they owned 100% of it. Now they own 74% of it. They lost 11% in the seed round and 15% in the Series A. So just to get an idea of how dilution works. Okay, I hope this gave you a great understanding of how to prepare for seed fundraising. As always, in the description below, you can download this Excel template. And if you want to support my channel, please like, subscribe, and check out my sponsor, Notion, completely for free using the link in my description, which is the collaboration tool that I genuinely use every day to manage all of my projects. Thanks for watching, and I'll see you in the next video.